what banks do. In some banks, they just refuse the files which are under 700 or 500,000. They just don't take them, and other banks just increase the rates so that they discourage them.
Hello, and welcome back to the Real Estate Investors Club podcast, a show dedicated to real estate investing. And today we have a wonderful guest, Christian Pomerleau from PMML. But before we start talking to him, Terrie, wonderful co-host, how are you today?
I'm great. How are you guys?
Good. Excited for this conversation because there's so much happening. We're very lucky to have Christian Pomerleau from one of the top mortgage brokers at commercial mortgage brokers. I'm sorry for that, at PMML. Very, very knowledgeable, lots of experience, and we're excited for this conversation. As we all know, and I'm going to jump right into it. Interest rates are rising. There's a fair amount of uncertainty. Christian, please enlighten us. First of all, thank you for being here. Like, what are you seeing on the market these days?
Wow. Okay. Thanks for the intro. And yeah, it's direct. The rates exploded actually. And, you know, if we look at it, really the first question is, what's the problem? What's the problem that's out there right now? And the main problem we all know is inflation, you know. And this is what the government, and this is what actually everybody has to fight, is this major inflation, because when inflation gets out of hand, then this leads to a recession. And we don't want to go there, even though we're getting closer, but still we want to avoid that. So why? The other question then we should ask is like, why all this inflation? Like, why are we there, and why didn't we cope with that beforehand? It wasn't really easy. Today, you know, I see some economists and some people sometimes say, oh, the government should have reacted 6 or 10 months ago. And it's always very easy when something is finished to go back and be like, you know, we talked about the crystal ball, you know, we have the crystal ball once things are done, but it's very difficult to make decisions when we're in it. But the pandemia that we've been going through, you know, and it's like, hopefully it's ended, created things like income support, where people had to be helped, you know, just to go on. And then there was a lot of mechanisms that were put in place by the government to help reduce the debt pressure, and things like skipping mortgage payments, you know, especially like even for the multi-residential, some people were offered to postpone their payments for 3 to 6 months. And so these were all different mechanisms, or interest rates payment only. And then the government brought in loans, you know, where either there was no payments on the loan, or even like, you know, that $40,000 loan where people don't have to reimburse like 10,000 of it. So all these measures were put there. And then especially the other one was the quantitative easing.
Yeah.
And so much money that were injected in the market, and all this now is there, and it's creating a lot of pressure because, you know, economy was going better, people started spending, but there's a problem out there with this injection of money, is that even though there's a lot of demand, the problem now is a shock on the offer side, on the supply side. This is what creates the inflation, is this major blockage. The problem with the source of supply, the challenges with transportation. You have shortage in the workspace, and not the workspace, the workforce. Those shortages create a lot of pressure there, and we have the two main things are China, which are still in that challenge with the COVID zero that they want to contain. And when China is not working out, you know, and they're not exporting and importing, this is like 1/4 of the world's economy, which is kind of stuck. And then we have the war, and especially not just the war, but all the sanctions that come with it. So the big challenge with all this is that all this is creating a lot of pressure on the system. And worse than that is that now employment is like so low. The employment is high, unemployment is so low, and the salaries went up. I heard one of my friends tell me that his daughter is 21. She's been working in a store for 2 months and a half. She's now the oldest staff there. They put her supervisor at $24 an hour.
After
Like,
2 months, she's the oldest staff there?
Yeah.
Oh, mon
There
Dieu.
was this program like 1 or 2 weeks ago. They were saying that the staff turnaround is about 4 months in retail. So very difficult, you know, the enterprises, they try to keep their people. So the salaries because of that have been rising. Not to, before was only the high markets, you know, the professionals and the one that has the higher wages, they could go from one company to another and then ask for the sky. But now even in the mid and the smaller markets, the salaries go up, and there's lots of accumulated savings for this. So this makes another pressure on the makes it worse, you know, and worse, even over that, there's all this uncertainty where people and companies are so scared that inflation gets out of hand. So what they're doing is they're buying now, they're accumulating, they're saving stuff and all this. So imagine this is like a third pressure that's being put. So then the inflation just hopped up, you know, and now at 6.8%, and apparently it's going to probably go over 70%, 77%.
Goodness, not 70%. But yeah. Christian, let me just play devil's advocate for a minute. So, you know, I'm actually in France right now, and I can't believe how cheap everything is. So we have a Western economy. You know, they are facing the same pressures as Canada has, right? Like the war is the same here. China is the same as everywhere. And yet their inflation problem, like, it's like I took a time capsule and I'm now 2 years in the past, and you can go out and have lunch for $15, right? And so my question is this. I mean, one of the things that I've heard about the Canadian context is that we are overcommitted in real estate. And was looking at the data, and it's, you know, GDP, I think in Canada, we have one of, other than New Zealand, I think we're the most overcommitted in real estate in the entire world. And
I think 10%, over 10%, yeah, of GDP.
And so my question is, you know, in terms of how much is the real estate market what has been driving Canadian inflation, number one, and how much is this interest rate spiking a question of the government trying to cool the real estate market, and how much is it of them trying to bring down inflation? I mean, I don't know. Do you have an opinion on that?
Well, okay, I'll have one. Actually, you're right. I think the inflation has to be contained, and our GDP is strongly driven by real estate. And our real estate here in Canada, but here we're very sensitive to the rate increases because we're talking about the homes of people which are over indebted. And I think now the indebtedness of the households is something like over 170, I think, and this is probably here in Canada, our major challenge is the household debt, which has to be contained. And household debt also kind of goes hand in hand with our real estate. So yes, I'm sure real estate is probably one of the things that they have to a certain extent, calm down. But the thing is, every move that the government does does not have a very fast impact, because all these monetary policies we're going to start seeing the fruit of that in about 6 terms, so 6 quarters, like a year and a half to 2 years. So what's going to happen between that is a lot of is going to come out of the uncertainty and the confidence of people, whether they're confident or not, because that's where the people shift. They start moving the assets from either shares, bonds, or currencies, or real estate, or gold. And I heard this lady sell her car, $30,000 car. She's so scared she sold that to buy gold. So this is this is the funny things that people do when they're uncertain. And so there is an impact, and I think you're right. The main target is probably real estate.
Mm-hmm.
And so just,
if we, so no, Axel, go ahead.
Sorry. So just you've talked a lot about some of the shocks that have happened. Okay, so much money being injected at COVID, the war, China, and the supply side, and so on. Okay, and we're very committed to the real estate market in Canada. Some people are now saying, "I'm not buying anything. I'm staying on the sideline. I want to see what happens for 6 months." That's one group of people. The other one are saying, "No, I'm going to keep going. It's going to be full of opportunities." My question to you is, obviously, the increase in rates has a big impact on financing. For someone who's going to do a project, which is probably the most of our audience is still going to be active in the next 6 months and year, what kind of advice would you give to someone who's about to start a financing file?
Great question, because all this is about real estate. And I think the main thing I would say is two things. First of all, be prepared. Prepare everything, because we have to act a little faster. Rates move fast, and you want to be prepared. You don't want, the client doesn't want to be the one that is stalling his own or her own file. That's number one. But the second thing I would say, use good qualifying rates. So, talk to your broker and just look at what the market is showing out there. What are the real rates that we could get today? And then use, the stress tests. Use like maybe 50, 75, 1%, 50 or 75 points extra, or even up to 1% extra, and try to see if the file still works. And if it works, this means, you could be in business and it could work out. But yes, some people are still very active right now, but I think they're acting still a little prudently, because now we have to, by the time a file is done, most files are going to take between, let's say multi-residential, most files are going to take between 2 to 3 months to finish off, because some go with, banks are very long right now. They have 4 to 5 weeks delay. And if you add this CMHC for people that would go there, you have to add 3 to 5 weeks also. So time to completion to disbursement, this is a time that's very crucial, because the rates could still continue to increase. And we see like good deals, and we see horror stories right now. And every day, brokers like me are recalculating the COIs, like the certificates for the clients. We redo the pro formats, and we look at like how much more they have to put in cash down, how much less they're getting from equity takeout. So I would say be prepared. And the second thing is do good stress tests, and just go on. I mean, there is a market out there, and I think still most people are probably going to be calm during the summer, and we're going to wait for this. I feel we live through a tsunami right now. We gain like 85, 90 points, like almost 1% in about a month, and about 2.5% from the beginning of the year. This is major. We went from like a CMB, the CMB, which is the basis for a lot of the multi-unit residential financing, and this went up from 1.78 to about 4%. This is kind of major. It's one of the fastest increases. So I think some people are going to stay calm, and during the summer, when that first big wave just passes through, we're going to have probably smaller waves like a good tsunami brings. And then I think that the market is going to pick up in September and October with people coming back.
Mm-hmm. But let me ask this question. So, different financing environments are amenable to different kinds of projects. And you said you've seen some horror stories. Are there kinds of projects that you think work better in this kind of an environment and some that don't work?
Well, right now, probably the main challenge is really in construction. So there are people that are still going into construction, and that's perfect. I hope we're happy with them, but it's more difficult for beginners or for people that don't have very strong assets behind them. So I know that a lot of clients and people around that, are have small projects. They're putting it on the ice for a little bit, putting a little hold, because we have to know that 2 years ago, with rates being so low and even decreasing, there's a lot of construction projects that were saved like that. They were just going awkward, many mistakes, but they were saved by the interest rates. But in a rising market right now, the banks look at, the uncertainty parts. They always look at that. And normally the major uncertainty part is that no one wants to have cost overruns. This is probably the ghost of the banks, cost overruns. And that was always checked, to have a good contingency and make sure there's no of that. But right now, question marks in constructions are everywhere. Not just on cost overrun, they're on, like, are you going to have the workforce to do are you going to receive the material? Are the material price going to go up? Or so there's question marks everywhere. So you have to be solid to be in construction. So that's probably where I see the biggest challenges. And apart from that, the second major challenge is all the small buildings, either commercial or multi-residential. When we have financing below $1 million, or let's say, I'll put a little lower, let's say lower than 750,000, very, very difficult to place, very difficult. So people that are looking for smaller buildings, they don't have many options for financing, and they make things very difficult. Banks don't want them anymore.
So when you say very difficult to place, you mean you as a broker, you don't find financial institutions who want to finance this type of project?
Exactly. It's difficult to find them. Yeah. And we have to negotiate. We have to, we have to push them, and we have to look at the relationships that the clients already have. So, because the thing is that it's a big workload for small files. It's almost the same work to do 500,000 than 10 million, almost. And the thing is that what banks do, in some banks, they just refuse the files which are under 700 or 500,000. They just don't take them. And other banks just increase the rates so that they discourage them. So that's one challenge. When you're over 1.1 and 1.5 million, normally there's still good market. Multi-residential still goes well. And to add to this story, I would say that maybe a month ago to up to about like the last month and a half to up to 2 weeks went very low. Even us as brokers, we had less business. It's like if everyone was in the shock of all this. And but now in the last 2 weeks, I've been sent a lot of files, and we're overloaded right now with work. So I think people are just like looking at this and saying, okay, we have to get in this market. I think, like Terrie said, some people are going to get in the market. They just have to think that they're going to bring much more money on the table,
Mm-hmm.
Mm-hmm.
So look, Christian, this is really interesting. And I have about 5 more questions that I want to ask you. I'm sure, Axel, it's the same thing for you. But I think we're going to wrap up this particular episode, which was maybe more of a stage setting. And we're going to maybe move on in the next episode that we have with you to talk a little bit about solutions. And maybe, I know personally, I want to know what kind of projects you think might work well in this environment. So Christian, I want to thank you for spending this time with us today. And audience, don't forget, if you enjoy this content, subscribe, share, definitely look up Christian. Christian, where can people find you?
Well, sitting at my desk, I'm always there all the time, but actually, they could contact me directly on my cell at 514-826-2052 or by email. It's christian.pomerleau@pmml.ca. And I'll be there to look at your files and calculate them with you and see where the challenges are and all the opportunities. Hope to work with you.
Great. Thank you, Christian.
Thank you very much.